Hey guys, we are really flying through these, and I know that I'm doing this really quickly. I'm hoping that you can go back and watch any of these if I'm flying through them, but I'm trying to get all of the basics down so that we can jump into what this course, really is about, which is, how to turn this into a business. But I do think it's important to cover some of these topics. So the next and final financial statement that I'd like to go through is a cash flow statement. So a cash flow statement, I guess let me put my notes up here. It provides a detailed analysis of what happened to a company's cash during a specific period, which sounds really similar to a profit and loss where you've got revenues and you've got expenses, and it does contain a lot of the components that you find on an income statement. But an income statement is actually typically for GAAP, generally accepted accounting principles, is typically shown in accrual basis, which means it's going to show revenues as you earn them and not necessarily when the cash came in for that. Um, Whereas a cash flow statement is kind of supposed to be able to, it starts with a net income and it walks you through all of the changes to that and where your cash went from one period of running the report to another, to the end of whatever period that you're running it for. So it helps with liquidity analysis, right? You need to see whether say you have loan payments, which is something that not all of that would hit your profit and loss statement. Some of that would be on your balance sheet. But the cash flow statement is going to show those outlays of cash to pay those loans. And so it's really important during liquidity analysis. If you have a lot of loans on your books, you might be showing lots of revenue and not very many of expenses, but your business might still be in trouble because you're making payments on loans. And the cash flow statement is something that will show you that. It again helps with credit analysis because it's going to help you figure out, do you have the cash to meet your obligations? It's good to look at trends of it for future cash flows, and then it identifies flow problems. So really helpful. And then it really, in general, just exists to provide a transparent view of how cash is being generated and used. So now it's time to just jump right into one, and I'll walk you through an example in our company one. Here we go. So we're back to our company one. I am going to go to the report section again. And for some reason, QuickBooks does not put the cash flow statement up here, so I always like to go to the cash here, and it's called Statement of Cash Flows. You can just start typing cash. Again, since there's not a lot of data in this company, I'm going to flip this over to all dates. And I just kind of want to show you the different sections of a cash flow. And no matter what industry you're in, every cash flow statement is going to have these three sections. You're going to have operating activities, you're going to have investing activities, and you're going to have financing activities. So for your operating activities, you'll notice that it starts with your net income. So your operating activities are almost all on the P&L. That's going to be the revenues you're bringing into your company, the expenses, and the cost of goods sold that are going outside of your company. So this is going to start with your net income and kind of work backwards from that net income to get you back to the cash that you have at the end of the period. So here's some of the sections that would show up here in operations. You're going to see your changes in accounts receivable, because as you put things in accounts receivable, which is on your balance sheet, the other side of that entry is a revenue account. But you have to adjust that because you can put revenue on your books, but if that particular invoice isn't paid in the period that you're running this for, it's not impacting your cash because no cash has come in the bank. So this section that you're seeing where accounts receivable is being pulled out of your net income, that is because it's removing anything that was in AR that still had an open balance at the end of whatever period you're running. Same thing with inventory assets. Depreciation is a non-cash transaction where it is an expense on your books, but you're not paying somebody depreciation expense. That's just showing that your fixed asset that you have on your balance sheet is just a little bit older. So it's not a cash transaction, so you pull that out. Accounts payable is the inverse of the accounts receivable. So if you have things that are sitting in your accounts payable, that means you haven't spent the cash for it yet, and therefore that gets added back into your statement of cash flows. Credit card are exactly the same. So a MasterCard is going to show up like this. And then all of these you can see are just liabilities that you have on your books that really don't impact your cash because it's just sitting there as a balance that you're going to owe somebody in the future. So you'll see those added back in. So investing activities are going to be items in which you have purchased something that you're going to later use in your company. So you'll see here that they have a truck that is listed here, and that is because you purchased a truck. Um, but that's sitting as a fixed asset on your balance sheet. It's not something that necessarily you got it to invest in your company. So it's not something that was an expense for your company, but it does impact cash because you bought it. And so that's why you see that here. And then financing activities is going to be anything that's related to like interest that you've either earned on a loan that you've loaned somebody money, or interest that you paid on a loan to a lender that you have a loan out with. And then your opening balance equity is going to show up here. Opening balance equity is kind of QuickBooks's weird little way that they let you kind of start a set of financial statements in the middle of that company's life. So in concept, you would start with a completely blank financial statement, and then you would make your first dollar, and you would then see that dollar run through revenue, and then turn around and eventually run through that net income, and then come over into your net income on your balance sheet, and then the next year roll up into that retained earnings account, right? But in situations where maybe you're starting a new client in QuickBooks like this, they might have already been running a business, and so they have money that is already in the bank, or them personally, they have loaned money to the company, and so it's already sitting in the bank. And because accounting is a double entry system, you have to be able to put that equity somewhere. So what this opening balance equity is it's kind of the portion of retained earnings that you just put on the books. So a lot of times, especially if I'm working on a client that has some pretty messy financial statements, or has a huge equity section, like maybe they have multiple partners that were tracking, their investments in the company and their distributions out of the company, there will be times that I will take this opening balance equity and I will just merge the balance into retained earnings, because it is a retained earnings account, but it's one that QuickBooks has made so that if you want to, you can differentiate between the retained earnings that you're going to find the detail to here in the system, because you could run an all dates profit and loss and find where all of that retained earnings was generated, versus this opening balance equity where you just put it in and said it already existed before I started. So statement of cash flows, um, it's a different structure because it's kind of odd to see your net income at the top and you work your way back down to cash, but it's basically trying to say you started with this net income. Now let's adjust all of that for all the stuff that really didn't have anything to do with cash, and it splits it into the different things here so that you can get to the cash at the end of the period. And it's super helpful, again, to kind of just watch your cash flows and to make sure that your cash is not, you want this to be a net cash increase every month. Like, you don't want to be spending more than you're bringing in. So, in cases where maybe your net cash is negative, one of the first places that I like to look is, are we seeing a lot of accounts receivable where we're invoicing customers, but they're getting a little bit slower and slower to pay every month? And so this can provide clues that maybe I need to go look at an accounts receivable aging report and kind of see what's going on. Why is my cash being decreasing? If it's something like I just bought something for an investing activity where I went out and I bought a truck and that was just a big cash outlay, that is totally okay. But knowing what is causing your cash to go up or down is an important part of communicating with your client how their company is doing. But this is your statement of cash flows, and here pretty soon, let's see. I'm not really sure what we're jumping into next. Let's see. Looks like our next session we're going to talk about business structure. So I hope you join me for that.